you're going to create what we call phantom income. So those of you here have probably heard of like the Augusta strategy. That is something that really helps. So like the Augusta rule is, obviously it's like linked to the golf course, and it was people that were on the golf course wanted to rent their homes out, and now you can rent your home out for less than 14 days a year to your business to host a meeting there, for example, and you can take that as an expense. So what that looks like is, so Ridge runs a business, he's gonna hold a meeting at his home in the month of July. Fair market value of similar space in that town would be $1,000 for the day. He does it, has the meeting, has an agenda in the event that he's flagged for audit so he can show what happened, has a calendar invite, for example. He invites some colleagues and maybe his wife. So that's the supporting document piece to make sure this passes. He would simply transfer $1,000 from his business account to his personal account. He would not classify that as a distribution. He would classify that as a rent expense, and that would be tax-free to him. He does not pay any tax on that. So when we talk about setting up a separate entity to then basically self-rent equipment to each other, the problem that I see with that, that's where I'm like, there has to be more to that strategy that he's referring to, because at the base level, you're gonna have phantom income, meaning, let's assume something like Augusta rule didn't work, because like the Augusta rule is a specific strategy. If I wanted to rent a piece of equipment to myself, I'm still paying myself for that equipment, and now I've just created a phantom income on one side and a phantom expense so that it really shakes out to be nothing. And sometimes that phantom income can hurt you, because what happens with phantom income? You're gonna have self-employment tax tacked onto that as well, which is that 15%.